Hello and welcome to Magicbricks Now. This is India's first property channel and you're watching Property Hotline. I'm Kavita Krishnan. Today we are answering all your tax queries related to property with Jayesh Kariya. Jayesh joins me in the Mumbai studio. He's the partner, International Tax and Regulatory at BSR and Associates. Jayesh, welcome to the show. Let's get started. We have Ramesh Chandran who's dialed in from Bengaluru.
Sure.
Ramesh, how can we help you?
Yeah, my question is with regard to the TDS payment for property purchase. The question is, I have purchased the property jointly with my wife and the property value is more than 50 lakhs.
Okay.
Since I am paying the EMI from my income, can I alone pay the entire 1% TDS for the property? My wife is a housewife and no income. So I just want your answer on this.
So, Ramesh, tell us one thing. Is your wife a co-owner in the property or are you the sole owner?
No, she is a co-owner.
She is a co-owner. Okay, Jayesh, Ramesh and his wife are co-owners, but Ramesh is the one paying the EMIs. Who pays the TDS?
See, Ramesh, again, it is an interesting situation and which is very common situation. But what I understand that this entire property has been purchased by you out of your own money, and the wife is a joint holder for, I would say, the legal purposes. So she is not the, in essence, an economic owner from tax standpoint, and you are the economic owner from a tax standpoint. So therefore, I would say any obligation with regard to taxation would lie on you, and you are responsible for the tax compliances. So then comes to the 1% withholding tax, which is provided in Code 194 IA of the Income Tax Act. So that the responsibility of withholding of 194 IA rests on you, and you can discharge that withholding tax liability with the government. So you can deduct 1% from making the payment to the developer and then deposit with the government authority. So your wife need not have to comply with the provisions of 194 IA despite the fact that she is a joint owner in your property.
Right. But Jayesh, tell me this, and a lot of couples are doing this nowadays, that, both husband and wife are joint owners and they are also joint applicants on the home loan.
Yes.
So essentially both of them are availing of the tax deduction that they get on repaying, the home loan interest and the principal.
Right.
So in that case, who pays the TDS? Do both of them have to pay the TDS then?
See, if both of them are the economic owner and both of them are claiming the benefit of taxation, then yes, then both of are the buyer in that sense, and both of are would the SSC for the purpose of the withholding tax, and both of them will have to, depending on their share of the, I would say, interest in the property. Like take an example, if there is a property price of 100, and if a husband has a 60% share and wife has a 40% share, and if like take an example that a 60 is to be paid to the developer, then that 60 needs to be divided in the ratio of 60-40. And then whatever the amount that is being derived on that 1% needs to be withheld by respective taxpayers, and then needs to be deposited.
So this proportion that you're talking about,
Yes.
essentially if it is a property that is funded by a home loan,
Right.
then it would be how much EMI I am paying versus how much EMI my husband would be paying, and that accordingly you pay the TDS. Is that what you're saying?
Yes, Kavita. But it doesn't make whether funded, non-funded. You can either through an EMI or through your own funding kind of. So as far as you have agreed for a particular ratio that both are economic owner in a particular ratio, then that consideration needs to be split and withholding tax needs to be deducted accordingly.
Right. So whoever is the economic owner, now that's a new term that we're learning today. Economic owner is essentially the one who's footed the bill for that particular property. So the one who makes the payment for the property pays the TDS on that property. Key takeaway coming for all you home buyers over there, right on top of the show. Moving on, we have Rekha Naik, who's dialed in from Mumbai. Rekha, how can we help you?
Yeah. See, our society has one flat floor of 2,700 square feet built up, each divided into 7 units. In the last SGM, Special General Body, we have decided to have 5 share certificates of 50 each for each of the 7 units. That is 1750 per floor. So that all the floors will have the same share capital and 7 share certificates. Previously, the share capital was not equal on each floor, which was according to the number of agreements made on each floor. Is this step taken by the society okay and according to the bylaws? That is my first question.
Okay.
And the second one.
Yes, Rekha, go on.
Yeah. The second one is mainly, can we get an exemption from capital gains if we sell all the 7 units together and reinvest it in any other property, or is there an exemption only on the first unit and not on all the remaining 6 units?
Okay, that's a very interesting question over there. One flat is divided into 7 units.
Right.
And that is uniform across the society. That's a call that the society has taken recently. And if Rekha were to sell this as 1 unit, then can she avail tax exemption on all 7 of these, or does she get tax exemption only on 1?
See, as far as your first part of the question, that whether society can rearrange the share capital and then make it kind of uniform across the members qua the flat, that would depend on, I would say, the bylaws of the society. And if the bylaws permit, and if it is approved by the general body or a special general body, then I think the share capital can be rearranged among the society members. And I think that is perfectly legally valid, though I'm not a kind of a society lawyer, but this is what my understanding of the law. The second point with regard to that, whether all the 7 units can be considered as one flat. So that I would say would depend on the facts of the each case, but assuming that that for a, I would say for a legal perspective or contractual perspective, all 7 flats are 7 independent flats, then yes, certainly you can sell the 7 flats one together, and that would be kind of regarded either as a 7 unit or 1 unit. But I'm not sure how, from a, I would say from a physical perspective, you can really sell that 7 units. But if you are selling it to one party only, then yes, it can be possible, and therefore you'll have to sell all the 7 units to a single party because you can't subdivide the flat. And then the capital gain that you will earn will be kind of a capital gain from a sale of a residential house, and when you invest into another residential house, then you are entitled to kind of deduction under Code 54 of the Act to the extent of the capital gain reinvested. So if you have a capital gain of 100, and if you invest, if your sell consideration is 500, capital gain is 100, and if you reinvest 100, then your entire capital gain would be exempt from taxation. Hope I answered your question, Rekha.
So essentially, Rekha, you need to sell it to one person. If you're selling it to one person, that is one party, then you can avail capital gains tax exemption on all 7 units.
First question, because is it okay according to the bylaws whether we take this share capital?
Rekha, if you want, what we can do is we can get one of our legal experts to take that query. Now, that is something that deals with society bylaws. It's completely out of the purview of today's show where we are answering tax questions.
Yeah, so
we will, however, get that answered on Tuesday when we answer legal queries, right? Thank you very much for calling in. Do expect another call from our end to give you the answer to your legal question. Moving on, and you know what, Jayesh, before we move on, there's one other thing I want to ask you. Now, in Mumbai at least, there is this concept of Jodi flats,
yes,
which is quite common.
Yes.
People essentially buy 2 flats which are side by side,
right,
and which are just separated by one common wall,
right,
and they tend to break down that wall and put it together. Now, you've bought it as 2 different flats.
Correct.
What happens when you sell it?
Right.
How do you get capital gains exemption?
See, as I said, that when you do these kind of re-engineering or restructuring around the flat, then obviously you won't be in a position to physically sell it to 2 separate, I would say, the family owners, but it will be sold to one family, maybe jointly held by husband and wife or father, mother, kind of whatever it may be. And when it comes to kind of computation of capital gain, certainly that would be regarded as a 2 separate flat or a sale of flats separately, and capital gain would need to be computed accordingly, because what happens that when you are saying that a wall is broken and 2 units are being consolidated and created 1 unit, then what will happen that the cost of each unit would depend on the area of the each flat. And I presume, or what I would say the experience is that in that case flat A and flat B both are purchased on the same day and consideration is paid in the same day, kind of, right? So therefore you will have, I think, not much difference in the cost, but for a computation purpose, technically you need to prepare, I would say, or calculate capital gain for 2 flats independently.
So even if it's a Jodi flat, like
Right.
which is very common in Mumbai, you will have
Right.
to compute capital gains tax separately for
Right.
each flat. Even
Right.
if it is one person, one party in that matter,
Right.
buying both the flats.
Right.
Moving on, let's take an email query now. Sundar has written in, says he's in a joint venture
Right.
with a builder and the project will be completed in June 2017.
Right.
Now he's received 70 lakh rupees from the builder for the joint venture.
Right.
Does he have to pay capital gains tax on this? If yes, when does he have to pay this?
Okay. Now, Sundar, I am not aware of exactly what the joint development arrangement is all about. Is it a joint development arrangement or is it a development right? Now, here presuming that it is a kind of you have given your land to the developer for a particular consideration, and apart from 70 lakhs you are going to receive some additional consideration also. So if the 70 lakhs represents kind of what you call it as a refundable security deposit, if that is the construct of your agreement with the developer, then that 70 lakhs I would say would not be taxable at the time when you enter into an agreement. But as and when you receive the consideration either in the form of revenue share or in the form of a consideration at a later point in time or a constructed property, then your tax implications would arise accordingly at that point in time. Certainly it will have its own, I would say, complications from service tax perspective, and also could have implications from, I would say, your point of taxability point of view as well. So it all depends on the construct of the development agreement or joint development agreement that you would have entered into with the developer.
So if it's a refundable deposit, there is no tax consideration that you will have to pay on that, is what you're saying.
Yeah.
Right. We have Sachin Raina's question now, which he sent in on our website www.mbnow.in. He says he sold a house in Mumbai for 20 lakh rupees.
Okay.
Now he wants to know if he can buy agricultural land and build a house in his village using the sale proceeds.
Right. Okay.
Now I'm guessing there's nobody to stop you from doing that.
Yeah.
I assume what he wants to ask is about the tax implications of this.
Okay. So first of all, when a property is being sold, which is a house property, then certainly, and if it is held for a period of 3 years, so it will result into a long-term capital gain, and therefore that would qualify what you call it as an exemption under Code 554 of the Income Tax Act. Now, your point is that you are going to invest in an agricultural land as well as a house. Now, if you are investing separately an agricultural land which is away and which is not appertinent or adjacent or close to the residential house which you are buying or constructing, then you will be entitled to what you call it as a capital gain exemption under Code 54 only in relation to the house property, and therefore you have to calculate. But if you are buying an agricultural land and then you are converting a part of the agricultural land into NA, and on that you are constructing your residential house, and the rest of the land is still an agricultural land which is an appertinent to the, I would say, your residential house, then you can, I would say, take the benefit of both the agricultural land and the residential house for the purpose of computing the tax exemption under Code 554.
So what you're saying, Jayesh, is that if you want to avail tax exemption over here, you have to build a house on that land. You have to convert it into NA, a part of it at least, and build a house on that land. So residential property, the sale proceeds from a residential property has to be reinvested in another residential property. Only then can you avail tax exemption on capital gains.
Right. So just to give an example that your capital gain is 20 lakhs, and if you are investing, like take an example, 8 lakhs in agricultural land and 12 lakhs in constructing house which is independent of the agricultural land, then the exemption under 554 would be available only in respect of the 12 lakhs and not in respect of the 8 lakhs. But if you are kind of, it's a single property and you are constructing on the same agricultural land, then you would be in a position to claim exemption of the entire 20 lakhs because you reinvested that 20 lakhs into a house property, though I would say good amount has been invested in the agricultural land.
Right. Also, Jayesh, since here he is constructing the house, how long does he have to, kind of finish the reinvestment of the sale proceeds to gain capital gains exemption?
It's 3 years from the sale of the earlier property or the existing property.
This is if you're constructing a house.
You
have 3 years of time from the date of sale of the earlier property.
Yes, Kavita.
We have another email query coming in now. Ashok Hatekar says that he paid the final installment of his flat worth 79 lakh rupees to the builder on June 4th, 2013. However, he wasn't notified that he had to pay 1% TDS at that point in time. He received a notice recently from the tax department and has paid the amount. He also submitted the Form 16B to the builder and requested the builder to refund the TDS. The builder is refusing to do so even though he has received the TDS credit according to Ashok's Form 26AS. How can Ashok recover the TDS from the builder? Can you recover TDS from the builder?
I think the question, Kavita, would be can the Ashok can claim a refund of that TDS from the revenue authorities?
Revenue authorities, exactly.
So today the law does not have any enabling provision nor any mechanism to allow the refund of the TDS which has been deposited by the taxpayer with the government. But if Ashok, if you have to still make some payment to the developer and then your 1% withholding is required to be done, if that is sufficient enough for the earlier TDS that you have deducted by mistake or whatever it may be, so then you can adjust that. Otherwise, the only remedy is that you have to, I would say, negotiate with the developer and ask for a refund from the developer. And if you don't get a refund and if that amount is substantial, then you might like to take a legal course against the developer. Otherwise, I think you will have to treat it as a cost of, I would say, buying the house.
But in any case, Jayesh, is the developer supposed to be refunding the TDS because he is not taking the tax? It might be routed through him. A lot of developers are offering that services to you, but he's not the one who's taking the tax.
Kavita, once the tax has been deposited, right, with the developer, like in this case, Ashok has deposited the TDS amount as well as the what you call it as the
and then has received a claim.
Interest also, and that gets reflected in the, I would say, the 26As of the developer. So the developer will certainly get a credit of that TDS.
Right.
So therefore, developer is not, I would say, in a sense impacted to that extent, and then I think fairly and rightfully the developer should refund that amount to the buyer. I think that is, I think, the best approach for a win-win situation for buyer and the developer.
Okay, but that is not really being followed right now.
It all depends on, I would not like to make it as a general that is not being followed. It all depends on the relationship of the buyer and the developer, and again developer to developer.
So it's a request that you need to make, it's a claim
absolutely.
that you need to make with your particular developer, and if the developer refuses, then you will have to probably seek legal recourse. Let's move on to an email query next. Sahil Gupta says he purchased an under construction flat in August 2012. Now he made payments via construction linked plan. Agreement was executed on August 2012. He recently received possession of this flat. Now if he sells the flat, will he have to pay short-term or long-term capital gains tax? He also wants to know how he can calculate the index cost of the flat. So essentially he wants to know, Jayesh, from which date should he calculate capital gains? From the date when he signed the agreement or from the date of possession?
Interesting, I think, I would say question here. So, Sahil, here what you are saying that you got the possession in 2012. Sorry, you invested in 2012.
He signed the agreement in 2012.
Yeah, and recently you got the possession. Now, what the law says that when you have to compute a capital gain in relation to house property, then you have to calculate the, I would say, the position on the long-term capital gain when the possession is being received. That's what the law, because what you are saying is a house property, so therefore your possession date is important. That's what a lot of judicial precedents have also taken this position. So therefore, when you are selling the house property which has been held for less than 36 months, then it will result into a short-term capital gain, and therefore the question of indexation does not arise. But there is a kind of, I would say, not a very strong, I would say, argument, but yes, one can consider taking an argument, and if somebody wants to, I think, take a head on that argument, to say that what is being bought by you is, I would say, right in the flat plus a flat, and since the right was occupied or acquired in 2012 and which is now being sold after 3 years, so therefore that is a long-term capital gain, and therefore the benefit of indexation and long term should be available.
Giving us both views. Now, what does the buyer do?
I would say that the first view is, I would say, the reasonable and the better view. But if somebody is, like, take an example, taken that particular position and somebody is, I would say, in a litigation and therefore he would like to continue with the litigation, then I think the second view one can take, but not from a planning standpoint that one can take a second view.
So I'm still confused. So let me ask you this.
Yeah.
If you have bought this flat
Right.
and you signed the agreement in 2012, you got possession in 2015,
Yes,
and you were selling it today,
Right.
what date would you use to calculate capital gains tax?
Date of possession.
Date of possession, which is
Right.
2015.
Right.
So essentially what Jayesh here is telling you is that the date you move into the flat, when you start using the flat, is the date from which you should be calculating capital gains on that flat. So that is the date from which, and since it is short-term capital gains tax, in your case, indexation will really not apply. Let's move in now. Thomas is dialed in from Cochin. Thomas, how can we help you?
Good evening.
Good evening.
Yeah, I have a small land in Cochin, and this is a residential property. Okay, it's a plot with a small house in it, and the local government body has taken over a certain piece of the land for the road widening.
Okay.
And as a compensation, as against this small piece of land which has been taken over, they have given me another land, which is from the government land bank. And this means this is apparently an exchange deed. Like as against my property, they have given us another piece of property in somewhere in the city. So my question is whether this transaction, an exchange transaction, is taxable or not.
That's a very interesting question, especially when there's such a lot of development going around across the country, Jayesh. Does Thomas have to pay tax?
Okay. Thomas, very interesting situation, and I think people face this situation, that whether it is taxable, not taxable, and if it is taxable, then there is a kind of payment of taxes, or that results into a cash outflow, despite there being a cash coming into your own pocket. Now, what the taxation law says, that the taxable event arises when there is a transfer of an asset. The transfer definition in Code 247 is very wide enough to include even an exchange. So, when in a government acquisition, what is happening, that you are exchanging the one land with another land. So, therefore, that exchange technically would fit within the meaning of the transfer, and since it is a transfer, it will become a taxable transfer under Code 45 of the Income Tax Act. And therefore, you will have a situation that you will have to pay tax on your original cost of the land minus the market value of the new land that you have received, and therefore that would be what you call it as the capital gain, and on which you would be liable to capital gains tax. Unfortunately, here the exemption which is available under Section 54 or Code 54 of the Income Tax Act will not help, because the exchange is of the land and not of the house property. Had it been a kind of a situation that your old house is being taken over by the government and a new house is given, then potentially you would have, I would say, a fallback or a shelter under Code 54, and you would not have paid tax. But here, because it's a land, you would be required to pay the tax.
But that's not fair. The government is giving you with one hand and is taking away with the other hand. That's essentially what's happening in this particular case.
Yeah, but it still tantamount to an exchange, Kavita, because take an example that you have bought a land for say 5 lakhs, and today the market value of the land is 5 crore, and the government gives you another land equivalent of 5 crore. So effectively, what is happening, that you are exchanging one land with the other land. So both the lands are completely different, and therefore to that extent it will become a taxable event.
So Thomas,
So instead of paying you in
will...
cash, the government has given you a compensation in the form of another asset. So had there been a kind of a house property, then yes, one could have argued that yes, it is a exchange of land with house property, and therefore one can I would say think of applying Code 54 F over there and say that whether the exemption is still available or not available, depending on Thomas owning a house at that point in time or not.
So unfortunately, Thomas, in your case, it's land for land, so you will have to pay tax on it, and you will not be able to avail any capital gains exemption on that particular transaction.
But Kavita, let me just clarify that when he pays tax on the, I would say, the market value of the land that he got, so that market value will qualify as a cost when he's selling that new land kind of thing. So it's a preponement of tax kind of, in that sense.
And that's all the time we have on today's episode of Property Hotline. However, I would like to remind you what we learned today. This is precisely to do with buying a home and paying TDS on it. You need to, the person who pays for the house is liable to pay the TDS as well. Essentially, this means that if there is a couple, if there is a husband and wife who are buying the property together, and the wife, for instance, is paying all the money for that particular flat, then she has to pay the 1% TDS as well. Thank you very much, Jayesh Kariya, for coming in and answering all those questions.
My pleasure.
And if you have any questions related to real estate, whether it's about buying, selling, investing in property, whether it's about property taxes, whether it's legal queries or even home finance queries, reach us on the IDs that are flashing on your screens. We'll get the country's top experts to answer each and every one of them. That's a promise. Thank you very much for tuning in. Keep watching Magicbricks Now.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.